Welcome everybody to Volatility Trading Strategies. So in part one of this series, you can check it out here if you missed it, but I was talking about all the reasons why we need to rebalance our portfolios, and it's really quite simple. If we allow our portfolios to go unchecked for too long, then as time goes by and those asset values change, it looks less and less like the original intended allocation. So the real-world example I used was an investor who allocated 40% to stocks, 40% to bonds, and 20% to short volatility in 2011. If they let that portfolio go without rebalancing, by the end of 2017, even though the performance would have been good, the allocations would have changed dramatically, to the point where the portfolio would be holding 25% stocks, only 17% bonds, and 58% allocated to short volatility, instead of the original 20%, putting the overall portfolio at risk. Then something unexpected happens, we get a massive volatility event on February 5th, 2018, and the portfolio takes devastating losses. But those losses could have been greatly reduced had the investor just rebalanced the portfolio along the way. We can't eliminate risk completely, of course bad things can always happen, so we have to allocate accordingly. But good risk management means maintaining the original intended risk profile. So we've talked about the why we need to do it. Now let's get into the how-to, and I'll go over 3 of the most common ways that investors rebalance their portfolios, including the third one, which is my personal favorite, and how I rebalance my portfolio. So subscribe to the channel, smash the like button for me to make the YouTube algorithm think I'm more popular than I am, and let's talk about portfolio rebalancing. So the process of portfolio rebalancing is very easy. There's no heavy math involved here, and there's 3 methods that you could consider using. The first is what I call the threshold method. This involves you choosing a threshold for how far you're willing to let those allocations stray before you bring them back into balance. 10% is a pretty common number, but you could choose anything, 5%, 15%. It really just depends how strict you want to be with it. To illustrate, I'll do an example with a 10% threshold on a 3-asset portfolio. To match our risk tolerance, we have desired allocations of 40% to asset A, maybe it's stocks, 40% to asset B, perhaps bonds, and then 20% to a higher growth strategy. Asset C gets a smaller allocation because we've deemed it more risky. Now you can easily calculate how much of your overall capital these are just by taking your overall portfolio value, in many trading softwares they just call that the net liquidation value, and multiplying by those percentages. So if you had a $10,000 portfolio, you'd have allocations of $4,000, $4,000, and $2,000. If you're working with a $250,000 portfolio, they would each get $100,000, $100,000, and $50,000 respectively. But it is much easier to work off percentages here because of course the portfolio value will constantly be changing over time, hopefully growing, right? So if you run everything off target percentages, any basic calculator on your smartphone is all you need. So a 10% threshold rebalancing level would mean that if any of those assets are plus or minus 10% from their original desired allocation, that would trigger a rebalance, and we'd then try to bring everything back in line. So as time goes by and the asset prices naturally fluctuate, we can see asset C, which had an original allocation of just 20%, has grown. Since it's returned more, it's now up to 30% of the portfolio, and this is going to trigger a rebalance, which is very easy to do. Take your current portfolio value, your net liquidation value, and multiply that by the original intended 20% allocation. That number is how much you want to be holding of asset C given the current portfolio value. So whatever amount asset C you have above and beyond that number, sell it and free up the cash. That'll bring asset C back in line with the 20% you want. Then we simply do the same thing for the other 2 assets. Current net liquidation value times 40%, we want that much of asset A. Since it's a little less than that here, we just use some of that capital we freed up earlier when we sold some of asset C, and we top up asset A to the desired amount. Repeat the same process for asset B, topping that one up to the desired amount, and now we have a rebalanced portfolio reflecting all the original allocations. It's not going to be exact, of course, within a few $100s here and there is just fine, but now you're good to go until the next time one of these assets breaches your chosen threshold. And with so many brokers these days competing for customers, this can all be done cheaply or in many cases commission-free. So that's the threshold method. No complex math involved, and really anybody can do this. Now, your portfolio might be a little more complicated than just 3 assets, but it's still the same process. You just sell anything that is above the desired allocation, and you transfer that over to topping up anything that's below the desired allocation. You're just shifting things around a little bit and bringing it back into balance to make sure that no single asset is over-allocated and leaving your portfolio exposed to greater risk. So the second method of portfolio rebalancing is very similar to the first, and I call it the calendar method. This time, instead of setting a threshold that triggers the rebalancing, you just choose a time frame that would trigger it. So you could rebalance every 6 months, for example, just on that calendar schedule. Or something that is probably more common is just once per year in late December. You'd set your desired allocations, let them run for a year, and then once per year in December, you use the same method I showed you before to bring everything back in line. Sell portions of anything that performed well that year and are above where they should be, and put that towards buying anything that is below where it should be. Both of these first 2 methods, threshold and calendar, work very well for buy and hold investing. And I'm not exaggerating at all when I say that you could accomplish this in a few hours per year. That's all it's going to take. You certainly don't need to pay an expensive financial advisor a percentage of your assets to do what amounts to a few hours of work per year. There's plenty of resources online that'll teach you how to set up a buy and hold portfolio. And now you know you can use the threshold or the calendar method to very easily rebalance it on your own. Now, if you follow any of my other work, you'll know that I don't endorse buy and hold investing. Mathematically speaking, it will very likely lead to a low rate of return, probably only a few % higher than the inflation rate. It's better than nothing, of course, but despite what you may have heard, it's absolutely possible to beat the market. It just requires some out-of-the-box tactical investing strategies. So this is my current portfolio. 4 different strategies, none of them buy and hold, working together to create a diversified portfolio. Now, this isn't highly active trading. I'm not a day trader. Each of the tactical strategies average only a few trades per month. But that does beg the question, how do you rebalance a portfolio that isn't buy and hold? Well, it's actually even easier than the first 2 methods I showed you, and I call it constant portfolio rebalancing. I'm going to do a full dedicated video for just that method coming up next. That one is much more specific to my VTS investing community. I'm going to use my own portfolio as the example for how to accomplish it, so I want to separate that and really dive into it. So if you have any questions at all about what we've covered so far, I'm always available to bounce ideas off of, so feel free to reach out. See you next time. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.